Right.
Jacob said
Perfect. I was about to ask if you were going to start that.
Yeah.
Okay, so Bitcoin, um, as as uh, as it was said, is just nothing. I mean, it's nothing, right? Bitcoin, it's not anything that's real. It started out in 2007. This guy or a group of guys that worked under the pseudonym Satoshi Nakamoto started writing the code in 2008. Towards I think it's like August or something of 2008, they registered or he registered Bitcoin.org, and then mined his first block in the beginning of 2009. And I'll explain what mining is and I'll explain what blocks are in just a second. But that was kind of the start of it. The Bitcoin technology, they refer to it as the blockchain. And this is, it functions for the Bitcoin network, as you can call it, as a ledger of transactions. So you have money, you have Bitcoins, and if I wanted to send Bitcoins to someone else, like I have, they call it like a wallet address, and you can make multiple of these. You can have as many as you want. They're identified based on either hardware. You can get like a USB key or something that has your wallet ID on it. That so basically nobody can access unless you can plug it into something, and then the software that does the trading references that hardware key. Or like if you're on Coinbase or something, you can generate a key for your wallet, and then it's just an identifier for you, and you can make multiple so that it makes it harder for people to track your money, but it's all public information. And so like I have money, the network, as you can call it, knows that my wallet address has 10 Bitcoins, for example. And so if I want to send one to Patrick for any sort of reason, for services or for items, I, we go and we put that transaction into the network and say one Bitcoin goes from this wallet address to this wallet address. And then that is a transaction that goes into the network and eventually will end up in a block that gets written to this ledger, the blockchain. You can put anything in there. Generally, there's like a hard limit, but kind of a soft limit on the size of it. That's 1 megabyte of data. So you can't put a lot of stuff in there, but like people mess around and like you can squeeze stuff in there. Like a guy or commissioner for like the FTC or something like that, Bernanke, somebody squeezed in an ASCII Bernanke in there, and like this is what I mean. He looks like that, right? I don't. Let me see if we can find a picture real quick of the guy. Ben Bernanke is his name.
Yeah, former chairman of the Fed.
Yeah. That's the guy. Here's a picture. I'm trying to pull it up. Can I get out of this? Did it just kill the whole thing?
No, I can see your Chrome. Yeah.
You see, yeah, this guy, right? It's like
Yeah.
this guy, right? Like, and so that's him for sure, right? And so you can squeeze stuff in there. It's not wise to do so because it takes up space. But you can, I mean, you can put anything you want in there. And then as long as the block gets completed and written to the blockchain, it's there forever, because as it goes, it always references back to the original Genesis block, which is what they've got. Like that green one at the bottom is the Genesis, and as it goes off, these purple ones you see are what they call orphan blocks, and those are like blocks that didn't get confirmed properly or came in too late, and so the blockchain had already moved on. And so those kind of get discarded, thrown away, and any transactions that were in there are not confirmed. They need to be reconfirmed, and basically they go back into new blocks. For what is actually in a block, every one of them starts with this magic number. It's a hex value here. It's literally this exact thing that starts every one of them. They also have the size of the block, so how big it is going to be at the end. You insert that in, so that when you're looking at it all, I guess you could see like how far down is this block before it goes to the next one. And then there's the header, which is the important part. It includes the version of the network that you're using. There's like a Bitcoin Foundation, and they make changes to it and add and change rules over time. It's very hard for them to do because of the way that the network works, but the version number there, the previous block hash, which is the referential back to the actual chain, and this is what makes it the chain, is that each block references the one before, so you can look up by ID what they are. So I can look up like the current block, and if I look it up by ID and I say, what's the current one? Well, it'll say, here's the previous block, and I can click on that. Like there's a bunch of different blockchain browsing websites that you can go through. And you click on the previous one, it loads the previous block. So you could just keep clicking and going all the way back. And eventually you'll end up at the first one that, that Satoshi made in 2009. And he put in there, actually, some of the data he put in there was like an article about the instability of the economy at the time, and like something about banks getting bailed out. It was a Times article title that he put in there as like a reference of the time and kind of something that was relevant to what he thought his philosophy was and why he wanted to put in the blockchain, create Bitcoin and have a decentralized currency. The transactions hash, which is just a collection of all of the transactions, and all of this hash that I keep referring to is an encryption method. That's the next slide here, but they just take all of the data, they encrypt it, and then it pops out a data value. The current time, the target difficulty, which is it's like a very small decimal number that the value of your block has to be smaller than that, and that's the hash value. Again, I'll get to that on the next frame, on the next slide. And then a nonce, which is just an arbitrary number that they put in. And so what your miners will do whenever they create a block is they'll scoop up a bunch of transactions. They'll process all of the header information that needs to be there, the transaction counter and the actual list of transactions. They'll process this whole thing and they'll build the block, and then they'll run through at a ridiculous speed all of the hashing algorithms. They sell them when you get a Bitcoin miner, they're like 10, 15, 20 terahash. So they're doing these things at like a ridiculous speed. Tera being like 1,000 gig of hash, which is 1,000 mega hash, which is, it's running through and it's running these encryptions, and so it's changing this nonce number over and over again, trying to find a block that your total hash value at the end of it is small enough that it beats the difficulty. And so I pulled up a 256 hash, SHA 256 encryption calculator, and I just typed in the text test 1 and test 2. These are the outputs for that. This graph here is I think this is SHA 1, but just showing anything you put in, you'll get an equal length hash value that comes out of it. And so for this, test 1 gives you this, test 2 gives you this. When you encrypt the whole block, which is a bunch of transactions and stuff, if you run your encryption algorithm, and the Bitcoin encryption algorithm, it does it multiple hashes. I don't know exactly the inner workings of how it encrypts everything, but it does takes 4 sections of it and encrypts it in 2 of them together into one, and then the other 2 together into the other, and then those 2 together into the big one, and so you get one. As you hash your block, and again, this change, every time you change the nonce, it gives you a new, effectively random hash that comes out. And you're just trying to hopefully get the right nonce in your code to output a number where the first 23 of these are zeros. And then the rest of it, because that's it's a 32-bit number here, this hex value translates to. So if you translate it into decimal, this is a number that I can't even describe. Yeah, so you're trying to get one that has a whole bunch of zeros at the beginning, which is effectively a 0.0000001% chance of coming out, right? So it's just it's a really, really small number relative to what it could be. And whenever you get one that comes out that beats the target difficulty, that's a successful block, and that gets written in, and the miners pass that off to they have nodes and servers that they all check in to, and so it passes it around, and then all of the miners confirm it and say, hey, when I run this block, I get this hash which beats the difficulty, and so it's confirmed. And then they just pass that around. They basically tell the whole network, and over the course of a couple of seconds to a minute or so, everywhere in the whole world where people are mining Bitcoins know that, hey, we've got a new block on the blockchain. So this is what we have to start with when we're trying to create a new block. The difficulty level is changed every 2 weeks or so. And it's based on the average time it took in those 2 weeks for a block to be formed. The guy, when they started it, the target was for about every 10 minutes a new block is found. So if it takes longer, say all of China shuts down their miners, and they've got China's got a ton of miners, just across the whole country. I think the government it funds it. They've got a lot going on there, and then a lot of people there probably are also just doing it privately, whatever. They've got a lot there. There's a lot in like Northern Europe and Iceland, Greenland, stuff like that. So like if say they all turn off their miners, well, the network speed is way slower. So there's like maybe you cut it in half, and less than maybe half of the amount of miners are going. So there's half of as many attempts at hashing a block in general. So the chance of someone getting one, again, it's effectively random. The chance of someone getting one is way smaller. So it may take 20 minutes, 30 minutes before somebody finds one. And of course, the longer it goes, the higher chance that someone eventually gets one, just because you're changing that nonce over and over again. It's just like, as you go, like if nobody's found one yet, you make a minor change and you keep going, you make a minor change, you keep going, eventually you'll get one that works. Mm-hmm. So as it goes, if it takes longer than 10 minutes on average, the difficulty drops. And so the number of zeros that start, that maybe instead of 20 zeros that start, it's only 19. So it's a little bit easier to find a block that fits, that passes your check. It'll drop. And if they go too fast, if the average is every 9 minutes over the course of these 2 weeks, and it's not sorry, I say 2 weeks just because it's long enough that it roughly turns out to be exactly 2 weeks, but it's every 2016 blocks that are found, it'll update the difficulty. So if it finds 2016 blocks in less than 2 weeks, then it says, well, we need to increase the difficulty, make it harder for this to happen. If the difficulty's up, and so a bunch of people start turning on a lot more miners because it's taking longer, and then it speeds up, and then they find blocks faster, they'll or vice versa. I think I did that backwards, but yeah, with the difficulty going back and forth, it'll fluctuate. Overall, it's going up a lot. It's much more difficult now than it used to be, but also the amount of miners that are running, and the amount of the total, they call it the total network speed, is the hash rate of the entire network. If you just add up everybody who's mining, is much higher than it was. Let me look real quick if I can see current network speed for Bitcoin. Currently, network statistics.
So once you get a successful block, that's like when the Bitcoin payout comes, right? Once you find success.
Yes. And so,
okay, there we go.
Right. Yeah. So here we go. Yeah. So when you're mining, when you generate a block, and it's successful and it goes through, and all of the other miners check it and say, hey, that's real, and that guy didn't fake that. We're doing the same thing, because it's all public information. Your block has to be verified. So they grab the same transactions that you had. They use the same nonce you had. They use the time, all of the information that you put in the block. They check it all the same way. And if they run the encryption algorithm and it works, which it should, because it's the same every time for the same data, then they say, hey, that's good. We're good to go. That's a successful block. The person who mined it, which you, like if you have a Bitcoin miner, there's just a place you put your Bitcoin wallet ID in, and the wallet ID that was on the miner that found the block, it just spits out 50 Bitcoin to you, or at least it did. That's when it started. Every 210,000 blocks, which is roughly every 4 years, they half it. So it's currently at 12.5. It's been halved twice, and it actually halves again in about 20 days. I think 19 days from now, assuming the speed goes the way it's supposed to. It will halve again to 6.25. And so that's the Bitcoin you get out of it. Eventually, I think it has one more time after 6.25, and then it goes to no reward. The block will no longer give you a reward for mining it, because I think, once you're getting that small, it doesn't really make that much of a difference. Where you also get money from is transaction fees. And that's where the only way you'll get money from it after. And the transaction fees, you set it yourself whenever you make the transaction. Usually, rather than setting it yourself, if you're using something like Coinbase or a centralized wallet online, they'll set the fees themselves so that they can pull a little bit out of it. But those transaction fees are also rewarded to the person who mined the block. So if I say I'm a Bitcoin miner and I want to grab 100 transactions that have a bunch of, each one has 0.0001 Bitcoin, which is like, $10 or something, or $7, $70. They're usually like less than $10. It depends on how much money you're trading. Whenever it's like generated automatically, again, you can set it yourself if you have your own manual transaction that you're generating. But that is like you can decide which transactions you want to grab based on how much the reward is. If the reward is 3 cents, I'm going to ignore that one and I'm going to grab 10 of them that are $10, because that's $100 extra that I get for solving this block on top of the block reward that you already get. So that's also why you don't want to put garbage data in it, because that's just, if you have a limit of about a megabyte, you don't want to fit a bunch of stuff in there that's not transactions, because that's a lot of transaction fees that you could be getting that you won't have room for. And that can total up to be a lot, because a transaction is, I don't know the full data that goes into what a transaction is, but it's essentially, it's like your wallet ID, their wallet ID, and the amount of money you're sending to them, and the fee that you want to associate with it. So it's a very small amount of data, so you can fit a lot of transactions in a 1 megabyte file. So it's definitely something that you don't want to fill up garbage data with. Do I have another slide? No, I don't. Okay, so that's the basics of what the Bitcoin stuff is. And so where people, I think, get off track and like trying to explain it to people is where when they describe it kind of like a puzzle. It's like all of my miners are working together to try and crack this puzzle to where I get a block that, I solve a block is how that's how they call it. Whenever they talk about it as solving a block, but your miners aren't doing anything to solve an equation. They're just grabbing a bunch of data, running it through an encryption algorithm a certain way, and hoping that the number that comes out is really tiny. And if it is, then you win. If it's not, then they just change the number, do it again, and they're doing it, 15 quintillion times a second. Each miner you have is doing that. So it's like, it's just like, you're just hoping that you hit a random number, you're hoping that you hit gold. And if somebody else gets it first, then your miners just dump all the data that they had, grab new transactions, or keep the same transactions even, and then grab the new block ID number, and then rerun it all again with that. And they just keep doing that over and over again. One of the things that is more cost effective to people, because this costs a lot of energy and you have to pay an energy bill. What they'll do is they join what they call a pool. Slush Pool is one, Bitminter is one. I don't remember the names of all of them. There's a lot of different pools they have out there. And you'll join a pool, and instead of putting your wallet ID and your information in there, into your miner, you put the pool's information in there. Now, the network knows the miner that solved it. So they know where your stuff goes. They know which pool it's in. Based on what you put in there. So whenever you're going, like I have a couple of miners and they're in Slush Pool, and a bunch of people around the world are doing the same thing. So Slush Pool effectively is one entity that has, the mining power of, 1 million miners, like 1 million people that are a part of this group, and they're all mining together. So whenever it hits, if one of the Slush Pool miners hits, what they do is they calculate the amount of blocks that your miners have created, not solved, but created in an attempt to solve. and they discard some that are like below a certain difficulty. So if they're like not even close to getting right, then they say those don't count. So they take all the ones that are generally close. It doesn't have to be that close for it, but they take all the ones that are generally close and they say, this is the amount of work you did, and this is the amount of work they did, and the amount of work they did. And then they divvy it up, the reward, and they give out a small fraction of it. So you'll get, Slush Pool hit 20 blocks in one day over the course of the day, and they'll split all that up, and then you'll get 32 cents because you got 0.000001 Bitcoin because you've got one miner running in your closet. So you get a little bit, and it's using just a little bit of energy, but that gives you a little bit of like a trickle of money constantly coming in, rather than mining by myself. Say if I'm mining by myself, the chance of me getting it, if I'm 15 terahash out of the 50 petahash the whole network is, I'm, you know, tiny little man that I've got, one like 0.001% of the whole network speed. So I get, again, if this is all just random numbers, which it effectively it is, I'm mining 0.001 blocks out of everybody. And if there's one every 10 minutes, then it's going to take me, a year or two before I hit a block. So if I'm mining by myself, and I'm mining for a year, I just leave it in the closet and hope I hit. It's running, and hope I hit. If I get, say it's currently 12.5 Bitcoin. If I hit, that's what, quick math, it's $7,000 per Bitcoin right now, roughly. So that's almost $100,000, right? I spent $2,000 on my miner and I ran it for 2 years and I spent however much in energy. And then all of a sudden I got $10,000 because I hit. It's like, well, that'd be great, but I'm sitting there, I'm out a couple $1,000s for my miner. I'm out all of the energy cost. It's noisy, it's hot. So I'm paying extra for AC. And that sucks. Waiting 2 years, waiting 4 years, 6 years, who knows? Because you might not ever hit, right? A lot better. It's a lot less demoralizing to just join a pool and say, well, I'm watching this every day and I see 32 cents pop up every day, 0.0001 Bitcoins every day. And then I've got it set to, like most of them have it, where there's a threshold and it'll dump it in your wallet after it hits whatever you pick. So say I set it to 0.01 Bitcoins. And so every $700, or every $70, if I do 0.1 Bitcoin, every $700, it dumps it in my wallet. And then one day I look and it's been 2 months, and then $700 drops in my wallet. And it's like, hey, I just made $700 these last 2 months. It's a lot nicer than nothing, and then maybe something, But again, you never know, and that's another reason why I don't like the solving a puzzle analogy, is because it's like if you're working on a puzzle or whatever, but it's like every 10 minutes the puzzle's thrown in the garbage because somebody found an answer and you have to start a new puzzle. It's like, so you're just working on it, hoping that you hit, and it's just running. It's not, it's all it is running that encryption algorithm. That's why graphics cards were in high demand a lot whenever this thing kind of peaked. It was really hard to get a graphics card because graphics cards are just super calculators. That's all they do, is they just do math to figure out what things look like in a 3D environment. So like for your video games or whatever, but they're just really, really good at processing functions and processing, mathematical equations. So they're really good for doing this hashing algorithm with all these numbers, and they're just crunching all of that really fast. Your miners are made with special cards that do this for them, but like you'll see a lot of I remember seeing Razer has like a program where like that manages if you have a Razer keyboard or a Razer mouse or anything like that. There's like a little add-on that you can get where you basically mine Razer coins. It's an alternate coin to Bitcoin, but it just mines it in the background while your computer's not doing anything. And it's like, well, why not? Well, it uses up energy and it'll wear down your graphics card, but also like, I mean, hey, that might be worth it to you. And then they give you little Razer bucks and you can use them to buy things. I'm sure you can trade them out for real money. But that's all that it's doing, is it's just running these algorithms and trying to find a hash that's small enough to fit through the keyhole that is a successful block to go into the blockchain.
So for your rigs, do you have like, are yours, so I've heard a lot about like application specific circuits that just run the Bitcoin algorithm. They're not even computers. They're effectively just a circuit that only does the algorithm.
Yeah,
Is that what your setup looks like, or do you have
that's
actual machines?
so I have actual there. I bought a Bitcoin miner from Bitmain. So it's just a little. It's like this wide. It's like a little box, um, and it's got a bunch of chips, a bunch of like circuit boards on it, and it just like it's got a web interface, and that's it.
Hmm.
And so you log into the web interface, you set all your stuff up, and then they just run. They're loud, uh, and they just run. It's just that's what the machine is made to do, is just run that algorithm.
Yeah, I've also like heard this thing that even if you are working in like a distributed network, that it is now based on where we are in like the life of the algorithm, it is now impossible to recoup your cost of energy.
Very well, maybe it depends on how much energy costs where you are.
Mhm.
I think in places where it's a lot colder, it's a lot cheaper to do because
Yeah,
you don't have to pay for also the cooling. Then but I don't. I think that maybe not recently. I don't know where the current state is, but like back the last time I was looking at miners, like the new ones that were coming out were like really efficient. Um, like I've got some that do 15 terahash a second, right? But they've got like new ones that are the same size, cost the same. You know, the newer model of them. It's maybe it's 3 4 newer models newer, but they're like 40 a piece, and it's like, I would imagine that with how efficient they're getting, um, it's easier for it to balance out based on the amount of energy it's using, but then also at the same time, if those are more readily available, then the total network speed is going to be a lot higher because everybody can get those, and
right.
then it might balance out and then say, well, now it takes you twice as long to get the same amount, because the difficulty's gone up, because the network speed's gone up. It takes you twice as long to make the same amount of money, and then yeah, now it's it's a quick formula to do to see how much energy it is, but I don't know it. I would not be surprised if it's not cost effective,
Yeah.
especially on a small scale. I think on a large scale, it's probably uh, definitely worth it if you can, if you can afford to buy a whole bunch of miners and throw them up in Iceland where there's, where it's cold all the time, or used to be at least. Um, then you can probably make some money off of it. Um,
Because I
but
know
yeah,
Navy
it's like
guys, like the enlisted guys, they were always mining bitcoins because they have no cost of living. Like all their electricity's paid for, so they're like,
yeah,
screw it.
yeah,
They
yeah,
just
do
Yeah,
it.
I was going to say the same thing. We've got a bunch of guys in my squadron here that just mine Bitcoin because energy's free on base.
Yeah, yeah, run it, charge it to the government. Same thing with it's also, you could do like if you run a business, if you have a business, and you the amount of your electricity bill is a tax write off, run your miners, write it off. Uh you can do that, and then that kind of makes it a lot easier to recoup it because you're taking your money back from the government.
So one thing you were talking about with the transactions on a ledger,
Mhm.
so can any individual miner pick the transactions they want to include in their ledger, or is it standardized across the network?
You can you I don't know, like in the ones that I don't have a setting where I can go in there and change some stuff, but I would imagine on some of like the higher end ones, or like the ones that are all software based that run off your computer, you
Mhm.
can specify don't process a transaction unless it has this much of a transaction fee. I'm sure that's something that you can do. I'd be very surprised if you couldn't. Um, but there's no set of transactions that you have to that like you're required to take. Now, here's another thing. I guess the like if you're mining in a pool, some of the settings that you put in there, the pool might have a regulation on that, and then your pool determines which ones the pool tells your miners what to do as far as what to take and stuff like that. So they may do something like that. I don't know, but it's not if you're solo mining by yourself. No, you can do whatever you want. Like I said, you could even throw garbage data in there. That's not a transaction.
That's really cool. When did you start mining?
We got ours. Well, so I bought mine. I want to say in like 2017. Um, a guy I worked with. was into it, and he brought his stuff up to our office because he had a server, and he was like, can we do this here? And we were like, yeah, you can use our stuff if you let us in on it and explain to us how it works. And he didn't really know a lot, but he knew enough to get it going. And so we got it going. And like at the time, it was like $300 or so a Bitcoin. And so we kind of were messing around with it then, watching it, learning how pools work and trying to decide if we wanted to do a pool or wanted to solar mine, all that stuff. And then that was like October of 2016. And then about a year later, I bought a bunch of Bitcoin. It was about $600 a coin. And I put a bunch of money in there because like at that point, like I had been around it enough that I was confident that it would go up, and it in fact did. I bought some miners after that. So I bought, so that's what I want to say was maybe the end of 2017, beginning of 2018. Because I bought a bunch of Bitcoin, and then I actually used some of the Bitcoin to buy my miners, and because the value had increased, and so it became a lot cheaper per, the value of the coin was better. So like I spent a minuscule amount based on how much I bought to get those miners, and then from there, I think whenever it hit like $1,500 a coin, I sold a bunch and kept a lot. And then I think whenever it hit I think it hit $5,000 a coin, and then it dropped off a little bit. And so then I sold a lot more then. And then I sold the rest of what I had whenever it spiked up, not the end of last year, but the year before, I think, whenever it spiked up to like $17,000 a coin. And I was like, okay, this is enough for me. I'll get out. And then I sold it all. And then I bought some back again, after it tanked some. And since then, I've got it set up in that, like at this point, I'm not buying anymore and I'm not selling anymore, except for I've got a weekly transaction memorized where it just gives me $5 in Bitcoin every time, And so over time, if it goes up, I'm good. If it doesn't, then it's, whatever, it's $5 a week. It's not a ton, but as it steadily increases, which it has started to do again, I come out just a little bit on top. I end up probably not making any money because of transaction fees. Just because, again, I'm dealing with such small amounts that it's not, but if all of a sudden tomorrow it decides to go to $15,000 a coin again, I'd be in a good shape. I don't have a lot, but whenever it's that high, it's hard to not be making money if you're selling it.
So do you have like a hot take, like a hot opinion on where Bitcoin's headed, like in the next few years, or
I mean,
like John McAfee, it's going to be worth $50,000 a coin, kind of thing? Or?
I don't think it'll ever get to $50,000 a coin. That'd be a surprise to me. Wouldn't it be great? But no, I don't think so. I think I would think that it's going to coast around 20. Like we're at 7 right now. It spiked up to 7. I think the highest it got was 18, and it was 18 for like an hour, and then it dropped to like 12, and then it dropped to like 8. So like within the within that hour. So like it barely touched that, but it ramped up so fast. And I think people just it was right around Christmas. So I think a bunch of people were like, hey, I'm going to buy Bitcoin. And then it was right around Christmas. So people were like, time to cash in on all this money that I just got, So like, I think, but it tanked down to like 3, in March. I think we dropped from like 8 to like 3, and I bought some whenever, like I tried to buy it whenever it was under 4, and by the time my transaction had processed, it was $4,500 a coin. So like it was, and it's real volatile, and that's part of the reason that a lot of people don't like it, for good reason. But I bought some, and then like 2 weeks later, it had gone up like to 6 or so, and I sold off what I had because I didn't feel like holding that much in Bitcoin, not knowing what it would do. But I made, a couple $100 just because I was watching it that day for whatever reason. Yeah, I think somewhere around 20 is probably where it's going to end up stabilizing. Just because like I've seen it sit around 10 for a really long time. I saw it, start to climb up to 12, 13, and it seemed stable. It fluctuates a lot, right around where it's at, but generally you don't see huge spikes and huge tanks unless like something else is going on, like the pandemic, breaking out, which is why it tanked in March.
Yeah, I've heard like a lot of interesting arguments where, so a lot of people consider Bitcoin like a commodity where, in a time of economic crisis, people invest in commodities. But it was
Mhm.
interesting in this one where you had the stock market tank, but then Bitcoin also tanked right with it.
Right, which is really weird. It's
Yeah.
really weird. Usually it seems to kind of do the opposite of what the stock market does.
Hmm.
Um, Very strange to have seen it drop whenever the stock market crashed. Because that's like the whole point of it is like it's decentralized currency. It's not tied to any banks. It's not tied to any economy. It just kind of does its own thing. I like to think of it like you would think of gold. It's like gold has very limited uses. The blockchain has very limited uses. The things that it can do are great, and people need them for certain things. But for the most part, it's just shiny, and people think it's worth a lot. So you buy it, and you hope that it's worth more whenever you want to get rid of it. And so it's kind of the same thing. Stocks with nothing behind it. And so that's why uh, it's I think it's a good thing, and I think that with the whole global economy thing and how much we're learning capitalism sucks right now. Like it's just like or capitalism, excuse me, sucks, right? It's just like I think it's good, and I think it's probably something that needs to stick around, and I think people will see that, and I think it's going, like I said, I think it's going to coast somewhere around like 20, and then at that point it's not going to be like, oh, a Bitcoin's super valuable. If you had it and you held on to it, then it's worth a lot to you. But a Bitcoin being worth $20,000 doesn't mean anything, because what when people use it, like whenever you go to buy something, you just convert it to dollar amounts, and then so it's like, hey, I want to buy this thing. It's $20. Okay, $20 right now is this much Bitcoin. So here, I'll give you this much Bitcoin. So it's always in reference to the dollar when you go to buy stuff. Um, so I think it's I can't remember where exactly I was going with that. Um, but it's just like once it stabilizes, once it's which I think it will eventually do, whether it's at 20 or it's at 10 or it's at 5, whatever it stabilizes at, once it's stable, it's just going to sit there and people are going to use it just like they use regular money. um they call one of the things about Bitcoin, the value, like Bitcoin values, is that they only go to 8 decimal places. Nothing smaller than point zero 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 one exists in the Bitcoin. So like you have a penny is the smallest, 0.01, 1 cent. You've got they refer to it as a Satoshi, which is the guy's pseudonym name. One Satoshi is the smallest amount that you could have in Bitcoin. And so I think like if you get used to thinking of it like that, instead of one Bitcoin that could be worth 15,000 or $20,000, you think of a Satoshi, which is one, you know, a very small fraction of that. It's that's worth what's quick math on that? 17,000. If it's $20,000 of Bitcoin, that's what for. So $1 would be 0.00005. I think what that'd be 500 Satoshi, right? Is $1. I think that's right. Maybe not, but like it'd be like I've got this much Bitcoin, and you just start talking about it in that instead of full values of Bitcoin. It becomes a lot less volatile that way because your numbers are a lot smaller. You're dealing with fractions of it instead of the whole thing. No, it's like how much is gold, again, I know gold is a lot less volatile, but like how much is 1 ton of gold worth? Well, if the price per ounce of gold goes up 2 cents, well, 1 ton of gold is a huge price jump there. If you've got a whole ton, right? Like that's that. So if you're dealing with that much, it's like, yeah, well, that's really volatile at that point. So if you start looking at it in a much narrower scope, if you're looking at it as the value of a Satoshi, right? That doesn't change that much relative to everything else.
Okay, so you're like changing
The
you're
scale.
you're not yeah, okay, yeah, you're not looking at
Yeah.
it per Bitcoin, you're looking at a smaller
Yeah, you like look at it per Satoshi and see,
okay.
get a better name for, like the, a good value of it, but like rather than the smallest increment, the dollar version of the Satoshi, right? If the Satoshi is 1 cent, what's a dollar, in a Bitcoin? How much is that worth today versus 2 weeks ago? I don't think it would be, it's not that much different. So when you're
Okay.
dealing, if you're buying something that's $20, it won't make a difference to you.
Yeah, just like people don't track the value of a dollar necessarily like per day because
Right. Yeah.
trivial. Like you might lose a
Yeah.
couple cents here or there, but
Yeah. And if if you're a billionaire, it's like, well, that small change, it makes a big deal, and so you invest it all into other things. You don't care anymore because the dollar's worthless.
Well, cool.
Yeah, everyone in the Bay Area talks about Bitcoin, but I have no idea what they're talking about.
Yeah, I guarantee you they probably don't either. Like,
yeah, no, I'm
sure
of it.
Yeah.
I think it's just a word people like to use to impress people.
The blockchain.
Yeah.
Yeah, the blockchain. Yeah, I hope that was coherent, and I hope that it helped.
Yeah.
Just a bit. Just a very surface level, basic explanation of what's going on and what it's actually doing. Because if you get caught up in the metaphors, it turns into magic, which might be where it needs to be. Who knows?
Cool.
Yeah, that was really cool.
Yeah, I really appreciate you putting that together. It's awesome.
Yeah, no problem. Trying to think if there's anything else that I know about that I could present, because this is fun,
Yeah, I was trying to get Max. You still in here? Yeah, you need to do a presentation on some doctor shit for us.
Oh God.
Some psychiatry.
What do I know about in psychiatry? It's just not that interesting. I don't know how to read minds.
Just prescribe drugs for them.
Oh God. I don't even know drugs. I am drugs.
Max is all of our drug.
That's Taylor, who is coming to us live from glorious Nippon.
Oh yeah.
Glorious.
What time is it there? 9 a.m.?
Yeah, it's 9 a.m.
Oh, okay. I was gonna say it's gotta be pretty late, but it's even later than I thought. It has now become early.
Next day.
Hello.
Child.
Here you go, Esther. Do you want to look at everybody?
Dang.
Dude, stone cold killer right there.
Yeah, she's got a cool mullet.
Rocking it.
She is not interested.
She's staring you guys down. Oh, I think her mom's awake and downstairs, so probably much more interested in that.
All right, cool. Well, we'll have
Sit
to
her down,
come up with a topic for next week.
Oh my God.
That's on hold for now.
Yeah, maybe the psychologist should psychiatrist. Oh my God, I'm so sorry. Maybe you should diagnose us all.
Oh God. I can talk about personality disorders. That seems to come up, and the characteristics and traits therein. That's relatively, it's something. I don't know if it's interesting, but
what do you think of the DSM?
Oh, DSM, yeah. It's a book written by a lot of people that have some strong opinions.
That's your opinion. It is a book written by a lot of people.
I mean, they tried to de-diagnose pedophilia. They were trying to make that not a psychiatric condition. So there are some opinions about it and written about the people you would expect.
Okay, well, we'll save that one for next week.
Yeah.
Come on.